The reason I think that liquidity is probably headed up in the next 18 months is because we're heading to a cutting cycle globally. And as we talked about before, some of these like bank credit indicators, if anything, they kind of bottomed in like 2022, 2023. They're still not good, but they're like less bad, let's call it, in rate of change terms than they were before. And I think that you'll have fewer headwinds from those um, happening. Then you add Chinese stimulus and you add, whatever else we might get. So my base case would probably be higher liquidity over the next 12 to 18 months at a time when, Bitcoin's not really overvalued by most of its different ways of kind of measuring overvaluation. And so that's why I have a fairly bullish view on both.
Did you know that Bitcoin tracks global liquidity more closely than any other asset? In fact, when global credit creation ramps up, Bitcoin typically follows suit. According to a recent study, Bitcoin's movements are tied to both a weaker dollar and an increase in credit creation. Lyn Alden highlights that with the upcoming global cutting cycle and signs of Chinese stimulus, liquidity is likely to increase over the next 12-18 months. This means Bitcoin could be set for a significant run. And here's why you should pay attention to this trend. Plus, with Bitcoin currently not in a valuation bubble, the conditions are looking even more favorable.
I've been long gold since 2018. Um, in 2020, I got a little cautious around its kind of overbought status. I didn't necessarily think it was going to chop for like 3 years, but it did. And I just kind of stayed bullish, and it broke out. I was kind of looking for that kind of like breakout, and we got that. Right now it's a little bit overbought again, and the dollar's a little bit oversold. So I have some near-term concerns around gold, but I'm not really trading around those concerns. I'm still bullish with a 3 to 5 year view, and I prefer owning that to long duration treasuries in any sort of structural basis. Again, trades are trades, but it's like, what do you want to hold for 5 years? I would pick gold. Bitcoin, I'm pretty bullish on. I collaborated with Sam Callahan. We published a study the other day that kind of analyzed the correlation between Bitcoin and various measures of global liquidity. And we found that Bitcoin follows global liquidity more than any other asset. And so when you generally have either a weaker dollar or more credit creation globally, um, those conditions tend to be good for Bitcoin. And then you can temper that by looking at certain valuation measures for Bitcoin. We used market value versus realized value. So market value is just the market cap, and realized value is kind of like the on-chain cost basis. It's like the value of every coin the last time it was moved. Like, what was the price in dollars last time it was moved on chain, which is often when people either send it to an exchange or pulled it from an exchange. Um, and when you get a really big bull market in Bitcoin, you get a really big kind of multiple of market value versus that kind of realized value on-chain cost basis,
Mm.
and that tends to presage forward bad returns for a few years and a breakdown in that liquidity correlation because that kind of bubble can unwind and override any sort of liquidity correlations for the next 12 months or so. And right now we're not really in one of those valuation bubbles. There's a pretty normal divide between market value and realized value. And I do think liquidity is probably going to look positive for the next 12 to 18 months. So I'm pretty bullish on Bitcoin. I don't really know what it's going to do for 3 months or so, but I am pretty bullish with an 18-month view. And we've generally seen periods where gold outperforms Bitcoin, periods where Bitcoin outperforms gold. Between the two, with Bitcoin's higher volatility, we've had better performance, tempered by its higher volatility. And I think owning both as part of a portfolio is attractive. And I also because I do venture work in the Bitcoin space, I also pay attention to a lot of the fundamental stuff that's happening. What companies are building new products on it? What are some of like the technical developments happening? With the different layers of it. So it's a market that I follow pretty closely. So we use global broad money supply denominated in dollars, and that second part's important because it basically we talked about before the global dollar denominated debts that are out there, and so how much the dollar strengthens or weakens in the context of global credit creation really matters. And so that basically that takes into account broad credit creation and the relative kind of strength of those currencies relative to the dollar. The reason we picked that is because we want it to be fairly reproducible. So it's not like a proprietary liquidity indicator that no one can reproduce. It's basically saying, look, it's not a perfect indicator, but here's the indicator we used, and these are the correlations we found with the logic associated with it. I know that there are some liquidity measures, like Michael Howe, for example, that it's a broader one. Um, but it includes more proprietary data gathering, harder to reproduce. In a perfect world, you'd probably have that. So you'd have like global M2, then probably global like all short duration government debt securities, um, and then you probably would incorporate some measure of bank tightening or loosening and of credit standards, and then private credit. Um, but I think that the benefits start diminishing. You get kind of the 80-20 principle where like if
Yeah.
once you're like 80% of the way there, you're not really like I never find that indicator is directionally differing from some of these more proprietary ones. It's more around the margins. And that's also why we focus on that valuation component because we found that having a good enough liquidity indicator and then combining it with a look into Bitcoin's valuations, that increases your like average likelihood of getting the direction right more than trying to squeeze every additional drop of juice out of your liquidity asset. The reason I think that liquidity is probably headed up in the next 18 months is because we're heading to a cutting cycle globally. Um, and as we talked about before, some of these like bank credit indicators, if anything, they kind of bottomed in like 2022, 2023. They're still not good, but they're like less bad, let's call it, in rate of change terms than they were before. And I think that you'll have fewer headwinds from those happening. Then you add Chinese stimulus and you add, whatever else we might get. So my base case would probably be higher liquidity over the next 12 to 18 months at a time when Bitcoin's not really overvalued by most of its different ways of kind of measuring overvaluation. And so that's why I have a fairly bullish view on both. So I've written about the fact that I think the Fed's a little bit overstated. Like the attention on the Fed's a little bit overstated compared to what else we could be focusing on, including like Chinese stimulus, for example. Um, but that it's indirectly important. So I think that kind of like how the U.S. economy was pretty insensitive to rates on the hiking cycle because we locked in so much fixed rate debt at a lower level. I do think that we're going to be pretty insensitive on the downside too, which is that because a lot of mortgages were already locked in at much lower rates, the refinancing cycle I think is going to be kind of weak this time because there was relatively low mortgage originations during these really high rate couple years, and so there's not a ton of like free lunch mortgage refinancings to just do out there and stimulate, and a lot of corporate investment grade corporations with fixed rate debt were already fine. So it's kind of the impacts on a little bit, maybe smaller businesses, maybe commercial real estate, some of these more troubled areas. So I think it's a lighter effect in the U.S. But then it allows these other countries to press their buttons too. So China, for whatever rate they might have factored in the U.S. decision, they now can pull their triggers a little bit more aggressive than they otherwise would. And you look at Brazil, they've had like double digit interest rates, like really high positive rates, trying to contain their inflation, trying to contain their currency debasement. And then to the extent that the U.S. rates go down, they can ease, and then therefore they can take off pressure on their economies. So I think that it kind of has a pretty wide disbursement effect as the U.S. cuts and all these other central banks cut, especially when you combine that with the fiscal side. So the fact that the U.S. is running these kind of structurally high fiscal deficits, uh, again, gives you that kind of background stimulus. And so it doesn't mean that all areas run hot in real terms, but it generally means that things are pretty hot nominally. And then depending on energy inputs and things like that, you can get decent real performance as well. Not particularly. My view is not to try to second guess the market too much in that area. I don't really feel like I have an edge for what a handful of people in a room are going to decide to do. I do have a pretty high conviction that we are going to get a higher low in interest rates. Like I'm not in the camp that we're going to go all the way back to zero anytime soon, um, and that's relevant for a lot of different things. So I have more of that like big middle of the range view, and that a lot of it doesn't really matter too much because it's the fact that it's not going to structurally lower lows every time is a pretty big change.
Now that you know how global liquidity impacts Bitcoin and gold, you're going to need to know about the next critical trend shaping the financial markets. Click on the next important video from this channel to stay ahead of the curve and keep your portfolio prepared.